Welcome to TradeTheNBA.com. This is John. This report is for the 9th of December. Well, that inevitable March. I mean, I remember back when the pandemic started, scared a few people, so much so that some thought I was nuts when we were, at the beginning of the whole pandemic, and I was suggesting the market would head towards that 4,000, and here we are now at 3,700, and, well, moving straight in that order, and this was something that confuses a lot of people, but invariably was built into the setup with what the Fed was doing. And this would mean there isn't a lot of economic hardship in that taking place, because I think there is, but this is sort of like in 2009 as the market rebounded, and there's that lag. And so the market is ahead of where things are in the sense of the recognition of the devaluation of the dollar through this excessive liquidity. And from a NASDAQ standpoint, also at the highs. Look at it, it's very consistent, shakeout, clean from that turnaround when we had to pause after the initial pop. It went flat for a little bit, and then it's been nothing but. And to be honest with you, too, December typically has this effect anyway, so it's not a shock from those kind of terms. From a euro standpoint, again, also higher because, again, the euro isn't going to be devalued as much simply because of the excess in liquidity comparative to what the Eurozone is able to do. So you get disparity there that's given that bonus. And that potential for the coming new year and additional stimulus is what's given gold its early rise. Nothing's changed with any of that. Currently, we're up slightly. We've had a little bit of, we've got obviously the contract ending for December, so that's the reevaluation is going to take place. But, gapped up positive extremes, had to fill those back in. Already did that, so that's been completed now. It's just in a new reset phase. We're in a little soft cycle right here just before a couple hours before the market opened. But from an intraday standpoint, this was pretty clean. We had the dip below the red line that was right there, made the new low that came right back to previous algo levels, and then boom. And then we start to add some additional levels as we go. We'll just go ahead and mark them as we see them, and I like to do that so that you can see exactly the identification process that I go through. So positive extreme right there, boom, that creates one. Then we end up with another set that's a little further. If that one got filled in, so that we can just go to the next one that starts right off. It's just right here. You see. And this is how you can kind of fill those in. And it's good to have them on your chart, because what you can do is as you go through, you can find the different step levels to see if they're significant enough, to warrant. By that meaning, you have a string of readings that go from there. And if they're too close, it's not necessarily as important to put them in. But, when you get that next series, and you can see how beautifully that one filled, because that becomes a brand new setup right there. And you can see we just traded right along it, and that's where it found its support even within the declining shakeout. And relative to the even number, which those tend to be popular anyway. And then, of course, the new set that's just taking place, which has already been filled on that breakout right there. And you actually could identify the lower level right here, which is the second portion, because the first one gets immediately filled in and boom, you tip. So you just have a range. And typically when you reach this break of the 35, usually we get to that 37.23-ish range would be my expectation to see a bounce to. That's typically where, from a breakout standpoint, you're going to get a move to, and it will clarify from there. So that's what I would be looking for in that. But I mean, clearly it gives you a nice set of readings within there that still have the potential for in softness to be filled and taken out. Of course, the dip below the red line in this particular case could also put one right in the middle range right there. I usually label those in red just so that you have a difference between the difference. Because a positive extreme is usually something that's going to be a little bit more directly associated as opposed to dip below the red line, which tends to get filled over a much longer period. Just depends on the amount of move outside of it, but it does give that broad retrace number. And I mean, it's significant from where we're already at now, so it's a good thing to have in there, and it kind of fills in that range, so it makes sense from that perspective. As always, though, anything relevant, I will certainly get it up on the Skype chat, go over it from there. As always, though, trade well.